Trillions of dollars are pouring into artificial intelligence right now. More money than any technology shift in modern history. More optimism. More promises. More certainty, at least on paper. But out here, on the ground, something feels off. Groceries cost more. Rent keeps climbing. Mortgages feel out of reach. And job security feels thinner than it did just a few years ago. Productivity is up. Stock prices are up. Executives keep saying the future has never looked brighter. So why does everyday life feel heavier? Why does it feel like people are running faster just to stay in the same place? Across America, warehouses are more automated than ever. Offices are quieter, teams are smaller, and decisions that used to be made by managers are now made by systems. You're told this is progress. You're told this will make companies more efficient. You're told this will eventually make everyone better off. But here's the uncomfortable part. Most Americans aren't seeing higher wages. They're not feeling more secure, and they don't feel like they have a seat at the table where these decisions are being made. Artificial intelligence is winning headlines. It's winning investment. It's winning market share. So here's the question nobody seems to want to ask out loud. If AI is winning, why doesn't it feel like you are? And this story isn't really about technology. It's not about code, or chips, or algorithms. It's about money. It's about power. And it's about who takes the risk when the future doesn't go the way it was promised. Because in America, big bets don't fail quietly. And when they go wrong, someone always pays the price. And the question is, who is that going to be this time? Every major tech boom starts the same way. Not with a product, not with code, but with a promise. A promise that life will get easier. A promise that work will get better. A promise that the future will finally feel stable again. And for Americans, stability has become the rarest promise of all. Over the last decade, the ground has shifted constantly. Jobs disappeared. Industries changed. Costs went up faster than paychecks. And every few years, there was another crisis, another shock, another reminder that nothing felt secure for very long. So, when artificial intelligence entered the conversation, it didn't arrive as just another technology. It arrived as an answer. On conference stages, CEOs spoke with confidence. They didn't talk about disruption. They talked about productivity. They talked about efficiency. They talked about growth that could finally be measured, optimized, and controlled. They said AI would remove friction from the economy, that it would eliminate waste, that it would help companies do more with less. And to many Americans, that sounded reasonable, even comforting. Because productivity sounds neutral, it sounds responsible. It sounds like progress without pain. In earnings calls, executives repeated the same message over and over again. AI would make businesses smarter. AI would reduce costs. AI would unlock new value. AI would help America stay competitive. This wasn't framed as a gamble. It was framed as common sense. And the media followed closely behind. Headlines celebrated breakthroughs. Articles described AI as the next industrial revolution. Panels debated which companies would benefit the most, but rarely did they ask who might be left behind. Because in the early stages of every boom, the story is always optimistic. You see it in the language. AI was described as a tool, a partner, an assistant, something that would help workers, not replace them. We were told it would free people from boring tasks, that it would give humans more time to think creatively, that it would elevate jobs, not eliminate them. And for a country exhausted by economic uncertainty, that promise mattered. America didn't just want growth, it wanted predictability. It wanted to believe that this time, things would be different, that this technology would finally align corporate success with human well-being, that companies could grow without workers losing ground. And for a while, that belief held. Stock prices rose, investments surged, tech leaders became fixtures on television, speaking calmly about the future. They spoke about AI the way previous generations spoke about electricity or the internet, as something inevitable, as something unstoppable, as something that would lift everyone eventually. And that word mattered. Eventually, because it suggested patience. It suggested that even if the benefits weren't immediate, they were coming. That all Americans had to do was wait. This is where the comparison to the dot-com era quietly enters the room. Back then, the internet was also sold as a promise of connection, a promise of efficiency, a promise of a new economy that would rewrite the rules. And in many ways, that promise wasn't wrong. The internet did change everything. It reshaped communication. It transformed commerce. It created entire industries that never existed before. But it also did something else. It concentrated power. It rewarded early winners. And when the bubble burst, it left millions exposed. At the time, that wasn't the story people wanted to hear. Because during a boom, skepticism feels unnecessary, even unpatriotic. Questioning growth feels like standing in the way of progress. Doubting the narrative feels like refusing the future. And so, just like before, America leaned in. AI companies grew larger. Budgets expanded. Infrastructure was built at record speed. Data centers spread across the country. Chip manufacturing became a national priority. Energy demand surged. All of it was framed as investment in tomorrow. And for investors, that framing worked. Because AI wasn't just positioned as the next product cycle, it was positioned as the foundation of the economy itself. If AI was going to touch every industry, then investing in AI meant investing in everything. That logic was powerful. It suggested safety. It suggested inevitability. It suggested that betting on AI wasn't risky, it was responsible. And once that belief takes hold, money moves quickly. Trillions of dollars flowed into companies promising AI-driven growth. Valuations expanded. Expectations rose. And still, the messaging stayed calm. Executives didn't warn of uncertainty. They didn't talk about trade-offs. They spoke in absolutes. AI would increase productivity. AI would lower costs. AI would drive long-term value. But here's the thing about promises. They don't need to be lies to be dangerous. Sometimes, they're dangerous precisely because they feel true. AI really does increase productivity. Automation really does reduce costs. Algorithms really can outperform humans in certain tasks. None of that is fictional. But productivity doesn't automatically translate into shared prosperity. Efficiency doesn't automatically mean better lives. And growth doesn't guarantee stability for everyone. Those assumptions are choices, not outcomes. And in America's economic history, those choices have often favored capital over labor. That's what makes this moment different and familiar at the same time. Because while the promise of AI feels new, the structure of the promise feels very old. It says, trust the system. It says, the benefits will trickle down. It says, short-term pain leads to long-term gain. And Americans have heard that before. They heard it during globalization. They heard it during automation. They heard it during financial deregulation. Each time, the promise was the same. And each time, the results were uneven. But in the early stages, that history fades into the background. Because when markets are rising, doubt feels unnecessary. When executives sound confident, it's easy to believe them. And when the future is framed as inevitable, resistance feels pointless. That's why the promise of AI landed so effectively. It didn't just offer innovation, it offered reassurance. It told Americans that the chaos of recent years could be managed. That uncertainty could be optimized away. That risk could be calculated, modeled, and controlled. In other words, it promised stability. And that is exactly what Americans wanted to hear. But there's a difference between stability as a goal and stability as a story. One is earned, the other is sold. And this is where the narrative begins to shift. Because while promises shape perception, they don't move markets. Money does. And money has a way of revealing what people truly believe, not what they say. And that's where this story goes next. Because once the promise is accepted, the next question becomes unavoidable. Who's placing the bet? And who's expected to absorb the risk if the promise doesn't hold? That's not a technology question. It's a financial one. And it changes everything. If you want to understand what's really happening with artificial intelligence, you don't start with technology. You start with money, because hype can be debated, narratives can be spun, but money leaves a trail. And right now, that trail leads in one direction, into AI. At a scale America hasn't seen in decades. This isn't just about startups or flashy demos. The real story is who's writing the checks and how big those checks have become. Start with big tech. The largest technology companies in the world are spending at levels that would have been unthinkable just a few years ago. Not on marketing, not on acquisitions, but on infrastructure, data centers the size of small towns, custom AI chips designed to run non-stop, power contracts stretching decades into the future. This isn't experimental spending. This is long-term capital expenditure, the kind of spending companies only commit to when they believe there's no turning back. Executives call it investment in the future. Analysts call it necessary to stay competitive. But the scale matters. Because when capital spending accelerates this quickly, it changes the math of everything else. Margins, expectations, risk. And big tech isn't alone. Behind them are the funds, venture capital, private equity, institutional investors managing trillions of dollars. These funds don't chase trends for fun, they chase returns. And once AI was framed as the foundation of the next economy, capital didn't just trickle in, it rushed. Funds that once diversified across sectors began concentrating exposure. AI wasn't treated as one bet among many, it became the bet. The logic was simple. If AI touches every industry, then owning AI exposure means owning the future. That logic moved money faster than any press release ever could. But here's where the story gets personal. Because the money flowing into AI doesn't just belong to billionaires or hedge funds. It belongs to teachers, to firefighters, to nurses, to office workers planning to retire someday. It belongs to pensions, to retirement accounts most Americans don't actively manage. And that's the part almost no one talks about. Even if you don't own tech stocks, your retirement probably does. Public pension funds allocate to technology. Target date retirement funds rebalance toward growth. Index funds automatically increase exposure as valuations rise. Most Americans never choose these investments directly. They're enrolled by default. And when AI became essential, those portfolios followed, quietly, automatically, without a headline. So, when you hear about trillions flowing into AI, understand this. That money isn't abstract. It represents future retirements, future security, future promises made to people who aren't sitting in boardrooms. And the spending doesn't stop with stocks. Follow the physical footprint. Data centers require land. They require water. They require enormous amounts of electricity. Entire regions are being reshaped to support AI infrastructure. Local governments offer incentives. Utilities upgrade grids. Communities adjust to rising demand. This is industrial-scale transformation. And like every industrial shift before it, someone pays up front. Sometimes it's companies. Sometimes it's taxpayers. Often, it's both. Chips are another piece of the puzzle. Advanced AI chips are among the most complex products ever manufactured. They require massive investment, specialized factories, and global supply chains. To secure those chips, governments step in. Subsidies are offered, national strategies are announced. AI isn't just a corporate priority anymore. It's a geopolitical one, which adds another layer of pressure. Because once governments tie national competitiveness to a technology, backing away becomes politically costly. At that point, the bet isn't just financial, it's institutional. And institutional bets don't unwind easily. This is why following the money matters. Because it shows commitment beyond words. It shows who believes enough to lock in capital for decades, who assumes demand will justify the cost, who's willing to absorb losses or pass them on. And here's the uncomfortable truth. Most Americans don't get to decide whether this bet is placed. They don't vote on capital expenditure plans. They don't approve pension allocations. They don't set index fund weightings. They participate by default, which means they share the upside, but also the downside. And that's not inherently bad. Risk is part of growth. Investment is part of progress. But only when risk is understood. Only when rewards and consequences are aligned. And this is where the tension starts to build. Because when you trace the money, you start to see an imbalance. Those who decide where capital goes aren't always the ones exposed if expectations fall short. Executives are compensated annually. Funds collect fees regardless of performance. Governments spread costs across taxpayers. But retirees don't get bonuses for patience. They don't get bailed out by narratives. They live with outcomes. And that brings us back to the core question of this chapter. If trillions are being wagered on AI, and if ordinary Americans are part of that wager, whether they know it or not, then the stakes are no longer theoretical. They're personal. Because if the bet pays off, the rewards will be uneven. But if the bet goes wrong, who actually pays? Up to this point, this story has been about systems, about capital, about infrastructure and investment decisions made far from everyday life. But this is where the story becomes human. Because behind every efficiency metric, behind every productivity chart, there are people whose lives are quietly being reshaped, not by a single dramatic moment, not by a robot walking in and taking a job, but by small decisions, incremental changes, and systems that never stop calculating. Start with the warehouse. Across the country, logistics centers run faster than ever before. Packages move in perfect rhythm. Conveyors never pause. Screens track every second. For the workers inside, the job hasn't disappeared. But the rules have changed. Many warehouse workers today aren't managed by people anymore. They're managed by scores. Every movement is tracked. Every pause is logged. Every decision is measured against an algorithm's expectation of optimal. There's a number attached to your performance, a productivity score, a ranking you never voted on, and that number follows you. If it drops, you don't get a conversation. You get a warning. If it keeps dropping, you don't get coaching. You get replaced, not by a robot, but by someone who scores higher or by no one at all. One warehouse worker described it like this: "I wasn't fired by a manager. I was flagged by a system. The system didn't know his name. It didn't know his injury history. It didn't know that his pace slowed because he was covering for a missing coworker. It only knew the number. And once the number fell below the line, the decision was automatic." That's the first human layer. The job still exists, but the humanity has been optimized out of it. Now move to the office. For decades, middle management was the backbone of corporate America. Team leads, project managers, department heads. They didn't just assign tasks. They translated strategy into reality. They handled conflict. They coached people. But in many companies, those roles are quietly disappearing. Not because companies no longer need coordination, but because AI systems are being asked to do it faster. Scheduling, performance tracking, resource allocation, forecasting. Tasks that once justified management layers are now handled by dashboards. One office worker put it this way: "My job didn't vanish overnight. It just slowly stopped mattering." At first, AI tools were introduced as support, then as decision aids, then as final authority. Meetings got shorter, decisions got faster, and fewer people were needed to approve anything. Eventually, the role collapsed into the system itself, not replaced by a machine with arms and legs, but replaced by software that never sleeps and never pushes back. And when layoffs came, it wasn't the entry-level workers who were hit first. It was the middle. The people whose value was hardest to quantify once everything became a metric. Now, consider creative work: designers, writers, editors, artists. For years, these jobs were considered safe from automation. Too subjective, too human. That assumption didn't last long. Today, many creative workers aren't being replaced outright. They're being absorbed, asked to produce more, faster, cheaper. With AI tools watching every step, one creative worker described her new role like this: "I still have a job, but I don't recognize it anymore." She wasn't told to stop being creative. She was told to work alongside AI, to generate drafts faster, to accept algorithmic suggestions, to justify every deviation from the model's output. The work became less about expression and more about alignment, not with an editor, not with an audience, but with an efficiency benchmark. And when she pushed back, she was told the same thing many others hear: "This isn't about replacing you, it's about helping you be more productive." But productivity has a way of becoming a ceiling. Once output doubles, expectations follow. Once speed increases, patience disappears. And suddenly, doing your best isn't enough. You're expected to do more simply because the system says you can. That's the second human layer. Jobs that still exist, but no longer feel secure. And then there's the third layer, the quiet one. The people who haven't lost their jobs yet, but feel the pressure every day. The sense that performance is no longer evaluated by humans. That context doesn't matter as much as output. That empathy has been replaced by efficiency. One worker summed it up in a sentence that keeps coming up again and again: "I didn't lose my job to AI. I lost it to a company trying to impress investors." That line matters because it reveals something important. This isn't a story about technology running out of control. It's a story about incentives. Companies aren't using AI because it's interesting. They're using it because it signals discipline, control, scalability. It tells markets that costs can be managed, that margins can be protected, that growth can continue without adding people. And in that environment, human concerns become secondary, not ignored, but deprioritized. The system doesn't hate workers. It simply doesn't see them. And this is happening quietly, incrementally, one workflow at a time. There are no mass announcements, no dramatic speeches, just updates, pilots, efficiency initiatives, each one small enough to justify, together large enough to change lives. And here's what makes this moment different. All of this is happening while AI investment is exploding, while capital spending accelerates, while expectations rise. While the narrative stays optimistic, the human cost doesn't show up on earnings calls. It doesn't appear in press releases. It doesn't fit neatly into growth charts. But it's real, and it's accumulating. Which brings us to the tension at the center of this story. If AI is delivering efficiency, and if companies are rewarded for deploying it aggressively, then whose responsibility is it to absorb the disruption? Who bears the cost? While the benefits are priced into stock valuations, that question doesn't have an easy answer, but it's becoming impossible to ignore. Because the human layer isn't separate from the financial story. It's where the consequences land. And, as AI investment continues to surge, the distance between decision makers and the people affected by those decisions keeps growing. And that gap is where the real risk begins. Up until now, the story of artificial intelligence has been told as a success story. Record investment, historic infrastructure build-out, endless headlines about transformation. From the outside, everything looks strong, but cracks don't appear where people are looking. They appear where no one feels the need to look anymore. Because real bubbles don't burst when things look bad. They burst when things look safe. And right now, on paper, AI still looks very safe. Start with earnings. Wall Street expected AI to do something very specific. Not someday. Not eventually. But now, AI wasn't sold as a long, uncertain science project. It was sold as a near-term productivity machine. Something that would reduce costs quickly, increase margins fast, and justify massive capital spending almost immediately. That's the promise markets priced in. But when earnings reports started coming in, the story became complicated. Revenue tied directly to AI has been growing, but not at the pace valuations implied. Costs, on the other hand, are rising fast. Data centers aren't cheap. Advanced chips aren't cheap. Electricity isn't cheap. And maintaining AI systems at scale is far more expensive than most early projections suggested. So, while AI headlines suggest acceleration, many balance sheets tell a slower story. Margins are under pressure, operating expenses are climbing, and profitability timelines keep getting pushed further out. None of this looks like failure, which is exactly why it matters. Because markets don't panic over small misses, they normalize them. Executives reassure investors. Analysts adjust models. Expectations are quietly reframed. Instead of asking, why isn't this paying off yet? The question becomes, how long are we willing to wait? And that question is dangerous, because waiting is how optimism survives. Now, look at costs. AI isn't a one-time investment. It's an ongoing commitment. Training models requires enormous computing power. Running them requires even more. Every improvement increases demand for chips, power, cooling, and specialized talent, which means costs don't plateau. They compound. This creates a structural tension. Companies are spending aggressively to signal leadership in AI, but the more they spend, the harder it becomes to show near-term profit. So they look for savings elsewhere, and that's where layoffs enter the picture. Here's the contradiction no one likes to dwell on. At the same time, headlines celebrate an AI boom. Thousands of workers are being laid off, not just in struggling firms, but in companies reporting strong revenue, not because business is collapsing, but because efficiency targets are rising. AI becomes the justification. We're restructuring, we're streamlining, we're preparing for the future. The market rewards these announcements. Stock prices often go up after layoffs, which sends a clear signal. Cutting people is interpreted as discipline, not distress. And as long as that signal holds, companies have little incentive to slow down. This is another crack. Because when productivity gains are real, you expect growth to absorb workers elsewhere. But when productivity gains coincide with sustained layoffs, it suggests something else. That efficiency is being used to protect margins, not expand opportunity. Now zoom out. None of this looks dramatic. There's no collapse, no sudden shock. In fact, this is what makes the moment dangerous. Everything looks manageable. Executives sound confident. Analysts remain upbeat. Capital continues to flow. On paper, this doesn't look like a bubble. But bubbles don't burst when things look bad. They burst when everyone feels safe. When risk is normalized, when warning signs are reframed as temporary, when the dominant narrative becomes, "This time is different," and that phrase has appeared before. During the dot-com era, during the housing boom, during periods when technology, finance, or innovation were treated as guarantees rather than bets. In each case, the cracks were visible early, but they were easy to ignore because money was still being made, because optimism was still rewarded, because questioning the story felt unnecessary. Right now, AI sits in that same psychological space, not fragile, not collapsing, comfortable. Wall Street believes AI is inevitable, that costs will come down, that profits will follow, that leadership today guarantees dominance tomorrow. And as long as that belief holds, the system reinforces itself. More spending, more investment, more tolerance for losses. But that tolerance isn't infinite. It depends on confidence. And confidence is fragile, not when things go wrong, but when expectations stop being met quietly. That's how cracks spread, not through panic, but through patience wearing thin, through timelines extending, through justifications piling up. And while this is happening, the human costs continue in the background. Workers absorb uncertainty, communities adjust, pressure increases, but markets stay focused on the big picture. Which brings us to the uncomfortable realization at the center of this chapter. The risk in AI isn't obvious. It's subtle. It's embedded in assumptions about growth, cost curves, and time. And it's being masked by a sense of safety. Because right now, Wall Street feels calm, very calm. And history suggests that's exactly when it pays to look closer. By now, it's tempting to jump to a simple conclusion. That artificial intelligence is a bubble, that it's all hype, that it's destined to collapse the way other booms have before. But that conclusion is too easy. And more importantly, it's probably wrong. Because a bubble doesn't mean something is fake. And it doesn't mean a technology doesn't work. It means something very specific. It means expectations got ahead of reality. Some of the biggest bubbles in history were built on real innovation. Railroads, electricity, the internet. Each of them changed the world. Each of them delivered enormous long-term value. And each of them, at some point, was priced as if progress would be instant, frictionless, and guaranteed. That's the distinction that matters. The dot-com era is the clearest example. In the late 1990s, the internet was real. It worked. It transformed communication, commerce, and culture. The mistake wasn't believing in the technology. The mistake was believing that every company touching the internet would be worth billions. Valuations assumed growth without limits, profits without delays, and competition without consequences. When reality caught up, the internet didn't disappear. Prices did. The companies that survived went on to dominate the global economy. But the capital that overpaid for timing, scale, and certainty was wiped out. That's what a bubble looks like. Not a scam, not a failure, but a mismatch between price and patience. This is why asking whether AI is real misses the point. AI is real. It already works in logistics, in medicine, in finance, in creative tools. The question isn't whether AI will change the economy. It will. The question is whether today's prices already assume that change is complete. Right now, AI is being valued as if execution risk is minimal, as if costs will fall on schedule, as if regulation won't slow adoption, as if energy constraints won't matter, as if competition won't compress margins. In other words, as if nothing can go wrong. And that's where bubbles form, not when people are excited, but when uncertainty disappears from the pricing. Markets are supposed to price risk. A healthy market asks, what could go wrong? A fragile market assumes, nothing will. That's the danger zone. And it's subtle, because the companies leading AI are strong, they're profitable, they have talent, data, and capital. This isn't a collection of shaky startups with no revenue. That's why the risk is harder to see. Overvaluation doesn't require weak fundamentals. It requires unrealistic timelines. It requires assuming that future profits arrive faster than systems can adapt. That infrastructure scales smoothly. That labor friction disappears. That political, legal, and social resistance stays manageable. History suggests that's rarely how it works. Every major technology transition moves in waves. Early breakthroughs, massive investment, rising expectations, then delays, then recalibration, then real, durable progress. The dot-com era followed that exact pattern. So did railroads. So did electricity. AI is likely no different. The danger isn't that AI won't work. The danger is that it's priced as if nothing can go wrong. And when nothing can go wrong, something usually does. Not all at once. Not everywhere. But enough to force a reset. And that reset doesn't mean the end of AI. It means a shift from promise to proof, from narrative to numbers, from belief to cash flow. Some companies will justify today's valuations, others won't. And the difference won't be intelligence. It will be timing, discipline, and cost control, which leads to the most important point of this chapter. Calling something a bubble isn't an attack on the technology. It's a warning about expectations. It's a reminder that innovation doesn't move at market speed, and when markets run too far ahead, they eventually slow down, sometimes gently, sometimes violently. And that brings us to the question investors rarely ask during booms. Not, is this revolutionary? But what happens if progress takes longer than we're pricing in? Because that gap between belief and reality is where bubbles live. Every boom creates winners. That part is never controversial. What matters is who those winners are and who quietly carries the risk underneath them. Because when you follow the incentives, AI doesn't distribute gains evenly. It concentrates them. Start at the top. Big tech is winning. The largest technology companies control the infrastructure. They own the data. They design the platforms everyone else has to build on. AI reinforces that advantage. The more data you have, the better your models get. The better your models get, the more users you attract. The more users you attract, the more data you collect. It's a feedback loop, and once you're inside it, scale becomes a weapon. Smaller companies don't compete on equal terms. They rent access. They pay usage fees. They live inside ecosystems they don't control. So, while AI is often described as democratizing, the economic reality is the opposite. Power consolidates. Now, look at executives. Executives are winning regardless of outcome. Why? Because their incentives are short-term. Compensation is tied to stock price, to margins, to cost discipline, to narrative. Deploying AI signals control. It signals efficiency. It signals that management is future-ready. That signal alone can move markets. Bonuses are paid annually. Equity vests on schedules. Careers are built on perceived leadership, not long-term consequences. If AI works faster than expected, executives win. If it takes longer, they often still win. They've already been compensated for making the bet. The downside rarely follows them personally. Now, consider early investors. They're winning too. Early capital entered AI before expectations peaked, before valuations stretched, before risks were priced out. They have optionality. They can sell into strength. They can rebalance. They can hedge. They're close enough to the market to react. They don't need AI to succeed perfectly. They just need sentiment to hold long enough. That's the upside side of the equation. Now look at the other side. Workers. Workers carry the adjustment cost. They're the first to feel efficiency, the first to be measured, the first to be replaced, compressed, or redefined. AI doesn't eliminate jobs evenly. It reshapes them in ways that increase pressure, more output, less tolerance, higher expectations without higher security. And when disruptions happen, workers don't get time. They get notices. Next, the middle class. The middle class absorbs instability. Housing costs don't fall when productivity rises. Healthcare doesn't get cheaper because algorithms improve. Education debt doesn't disappear because software scales. So when AI-driven efficiency boosts profits but not wages, the gap widens. Savings become harder. Mobility slows. Resilience erodes. The middle class doesn't collapse overnight. It thins, quietly. Finally, pension funds. This is where the risk becomes systemic. Public pensions, retirement accounts, target date funds. They're heavily exposed to the same companies driving the AI boom, not by choice, by design. Indexing, default allocations, long-term growth assumptions. Most workers don't manage these portfolios actively. They trust the system, which means they're exposed to valuation risk they didn't consciously accept. If AI exceeds expectations, pensions benefit slowly. If valuations reset, losses are immediate. And unlike executives or early investors, retirees don't get a second cycle. This leads to the core imbalance. Those who capture the upside are closest to the decision-making. Those who bear the risk are furthest from it. In America, the upside is private. The risk is shared. That's not new. But AI amplifies it. Because AI scales faster than policy, faster than labor adaptation, faster than social safety nets. In a normal tech boom, New industries absorb displaced workers over time. But when automation moves faster than retraining, and when gains concentrate faster than wages adjust, that buffer weakens. And that's what makes this moment different. Not the technology itself, the distribution. Who benefits immediately, who waits, and who pays if the timing is wrong. This isn't about blaming innovation. It's about recognizing structure, because systems don't drift toward fairness by accident. They drift toward incentives. And right now, the incentives are clear. AI rewards scale. It rewards capital. It rewards speed. It doesn't reward patience. It doesn't reward stability. And it doesn't protect those without leverage. Which brings us to the question we can't avoid anymore. If this isn't just a tech boom, but a restructuring of power and risk, then what happens when the cycle turns? Who gets protected? And who gets left holding the bill? Because that answer will define what comes next.